This is Rick Rule for Rule Investment Media and the Rule Classroom, sponsors of the 2025 Rule Natural Resources Symposium in Boca Raton, Florida, or via live stream in the comfort and convenience of your own home. In either case, it takes place July 7 through 11. A couple things as attendees that you need to know about the conference. The first is that over 4 days, we're going to give you more information than you can possibly absorb in 4 days. To that end, all of the proceedings of the conference will be recorded, and you'll have access to the recordings for a full year after the conference. And you'll need to do that to get your money's worth. The second thing is that before the conference, I interview every exhibitor and I interview every speaker so that you can familiarize yourself with that work and arrive at the conference better prepared to get your money's worth and your time's worth. Note too that every public company exhibitor at the conference has been vetted. If we don't own shares, they don't appear on the conference floor. We turn down more exhibitors than we accept. And finally, our attendees from prior years select this year's speakers. Speakers who don't poll well in terms of value created for our attendees are not invited back. I'm delighted to say that my next guest has always finished among the top speakers in every year that he's presented. He's presented for us for a very long time now, and the audience never tires of my next guest. James Rickards, thank you for decades of toil on behalf of voters, on behalf of taxpayers, on behalf of investors. And thank you in particular for your ongoing appearance at our Natural Resources Investment Symposium.
Thank you, Rick. It's great to be with you and with the audience. Yeah, I've done this, I don't know, 10 years in a row, maybe longer, but I would say at least 10 years. It's always a highlight of my, speaking tours and so forth, because mainly because it's such a great audience. With a good audience, you get tough questions, which I like, and you get the word out there. So it's always a treat to do it. I always look forward to it.
Tell us something about your background. How did James Rickards become James Rickards? We like our speakers, as I've told my audience, we like our macro speakers as an example, not to be failed journalists or influencers, like people to talk about circumstances that they have been or are players in. So talk to me about your background. I know you're an author, you're a lawyer, you're an economist. Tell us exactly how you came to be worth listening to.
Well, if you looked at my background, Rick, you would have one of two conclusions: either I'm eclectic or I didn't know what I wanted to be when I grew up. But I graduated from before I went to law school, I got a master's degree in international economics, focusing on development economics, and then I went to law school, and then my first job, I was there for about 10 years. I was international tax counsel to Citibank, and I was number two in the department. My boss went to Singapore and Tokyo, and I got to go to the Congo and Zimbabwe and places like that. But it was a good experience. I traveled extensively in Africa and the Middle East. I've been to a lot of places I couldn't go back to, including Sudan and Lahore and northern Pakistan and elsewhere. But I did it at the time. That was great. But I was an international tax specialist. What's interesting about that is that some things I learned 45 years ago are coming back thanks to Donald Trump, including withholding taxes on interest paid to foreign investors. That's the Section 899 in the big beautiful bill. We'll talk more about that at the conference, but that's something I have quite a bit of background in. So, International Tax Council, learned a lot about treaties. Then, after 10 years, I changed it up, and that's unusual because once you're that immersed in tax law, why wouldn't you keep doing it? But I switched to securities and derivatives. I became general counsel of one of the so-called primary dealers, major investment bank. But what's special about a primary dealer, which our firm was, is you deal directly with the Fed. So all the institutional investors, sovereign wealth funds, everyone else, they deal with the dealers, but there are select dealers, there are only about 20 of them, where you're approved by the Fed to deal with the open market desk at the Federal Reserve Bank of New York. We were on that list. So we talk to the Fed every day. And as a lawyer, I talk to the Fed in New York and Washington in many, many respects, and knew a lot of the people who work there. So that was my immersion in federal finance and fiscal policy after coming out of tax policy. So I got a handle on both. Did that for about 10 years. And then time to change it up again. I became general counsel of Longterm Capital Management. I was there before we were still startups before we had any money, but we opened with $1 billion in cash. That was the largest hedge fund opening at the time. There have been larger ones since then, but we opened our doors with $1 billion of cash. We tripled our investors' money in less than 4 years. We gave back all of it except for the first dollar. And then in a couple of months, in August, September 1998, we went down 92%. So you lost a lot on your dollar, but you got $3 back. So that's why investors were happy with the whole experience. But I always say if you mess up badly enough in America, they dump it in the lawyer's lap, and I was the lawyer, so I got to negotiate the bailout. So I dealt with I call them the 14 families. It was Goldman Sachs, Morgan Stanley, Citi, JP Morgan, the usual suspects, versus me and our relatively small legal team with the Federal Reserve looking over our shoulder. Treasury was involved. The whole world was watching. We came within hours. And people don't realize this, like, oh, yeah, okay, the bailout took place. By the way, Wall Street did not bail us out. They bailed themselves out because we had $1.3 trillion of open derivatives transactions. I say if we had gone bankrupt, I could have just slept in the next day. They would have had to deal with the $1.3 trillion net short position. Good luck with that. But we got that done. But we came within hours of closing every market in the world. And people don't realize that we were trying to get done a Sunday night before Tokyo opened. But sequentially, Tokyo Stock Exchange, London, New York would have closed for days until we sorted everything out. But we got that done. So that was quite an experience. After that, I worked at a couple other hedge funds. But after 9/11, I was tapped by the CIA. It turns out that during my Citibank career, I was asked, this is in the early 80s, I was asked to turn Citibank Pakistan into an Islamic banking organization because the Zia al-Haq, who was the president at the time, Iran said they were the Islamic Republic. And he said, wait a second, we're the Islamic Republic. Pakistan's, been doing this longer than Iran. So they demanded the banks go Islamic. So I went to Pakistan and worked with experts in Sharia and Islamic banking, and we did the conversion. A lot of it was superficial, but that's okay. I had to learn the ropes. Flash forward 20 plus years, I'm on the rooftop estate of a well-known investor in St. Croix, and I bump into a top guy, and I just tell this like an anecdote, like, yeah, I did all this in Pakistan. He said, well, if you got a call from the CIA, would you be willing to pitch? And I said, of course, who wouldn't? And anyway, that led to a 10-year career in the intelligence community doing counterterrorism. But we started out with financial counterterrorism. They didn't need me to jump out of a helicopter, but we were looking at money laundering and manipulation. We built artificial intelligence models in the early 2000s, 2003, 2004, that could predict outcomes based on financial information. So I'm still doing that in various ways. In our newsletter, I had a 10-year career at the CIA, and then got asked by I got a cold call from an agent. She said, Jim, how would you like to write a book? I said, I hadn't thought about it, but let's talk. We had lunch, we hit it off, and I put a book proposal together. And my first book came out, was Currency Wars, which was a bestseller, New York Times bestseller. And then I've written 9 books since then over the last, that came out in 2011. So I guess 13 years, 14 years. I've written a total of 9 books, all bestsellers. 3 of them were New York Times bestsellers, and the others were national bestsellers on different lists. And today I advise clients and give speeches and write newsletters. So tax law, fiscal policy, hedge funds, derivatives, counterterrorism, CIA, artificial intelligence, and author, you name it. But I've done it all.
So we have a fertile interview coming. I introduced you at one of our conferences as the guy I know who explains best the intersection of Wall Street and Washington. And I think that's a very useful skill for American investors in particular. So let's begin to go there. I want to explore more long-term capital management. I enjoyed Currency Wars, and I enjoyed a visit that you might not remember we having in Denver at a Casey conference, and your description about how your experience at long-term capital management and your experience in the resolution of that problem gave you a new appreciation for gold. We always want to draw this macro back to how our attendees can look at circumstances and not just survive but thrive. So I want you to tell us a bit about what happened at long-term capital management, how the resolution occurred, and what might have happened had the resolution not occurred.
Well, it was an interesting group. I mean, these guys were legitimate 160 plus IQ, so there was no question about that. But obviously, the thing went disastrously wrong. So and I was the lawyer, and my job was to do the bailout, and I did the bailout. So, you say you have to, how do you make lemonades out of lemon? And I said, well, I wasn't the risk manager. I was the lawyer. I was certainly there. I mean, I had a front row seat, but I kind of did my job in terms of negotiating the bailout and bringing that in, foaming the runways and bringing it in for a soft landing. But then I was like, well, where do I go with my career from here? And I came away very dissatisfied with they meaning, our partners' notions of risk management. I said, they really were smart. Two of them won the Nobel Prize. They were Harvard professors. That wasn't phony. That was all real. And yet the performance was very bad. So I said, they must be missing something. They're not dumb. They're missing something. What is it? And so I just kind of set out, as I continued my career in other respects, I set out on a personal quest to understand risk management better and market risk more broadly. And I spent a lot of time in the world of physics and applied mathematics and studying complexity theory, which is not well understood. Complexity theory has lots of applications that are very well established in, engineering and hydrodynamics and biology and bioengineering, a lot of other fields, but it's not applied very much, if at all, in capital markets, including the gold market and commodities markets. So I didn't invent complexity theory. It was invented by Edward Lorenz in around 1960. But I was one of the pioneers in bringing complexity theory to capital markets, which gave me a much, much better understanding of risk. And that if you can do that, you can do predictive analytics. If your model is flawed, your predictions are always going to be wrong. It's kind of like Wall Street. They have, who has a worse forecasting record than the Fed? Well, maybe the IMF, maybe the Office of Management and Budget, maybe some firms on Wall Street. They all get it wrong, and they're not dumb, but they're using the wrong models. If you understand complexity theory, which I do, and you use it, your predictive analytics go way up. I stood in the London Eye before Brexit on June 20th. Brexit was June 23rd, 2016. And on June 20th, I looked in the camera, I said, the UK is going to vote to leave the EU. Then Brexit's going to win. By the way, at that time, I said that the odds were 80% that they were going to remain. 80% remain, 20% Brexit. I said, they're going to Brexit, they're going to leave, short sterling, buy gold. For months after that, I got unsolicited emails and calls, thank you for putting my kids through college because I followed your advice and made a fortune. Those trades did work out very well. But it wasn't a guess. I was using the kind of models that I'm talking about, Rick. Same thing, I was on Bloomberg Live with Michael McKee, who's their big, macro maven, and Francine Lockwood was the host, live TV before the election in 2016. And she said, who's going to win? And Michael said, well, in 1992, we were all in bed at 10 o'clock or 10:30 rather, because Bill Clinton won in the East. He said, I think this time we'll be in bed by 10 o'clock. Hillary's going to clean up. She'll win easily in the East. She'll do better than her husband. And Francine turned to me and said, what do you think, Jim? I said, Trump's going to win. And she's white, but she turned white, and then her jaw dropped. And she said, is that because the polls are wrong or turnout's going to be higher? I said, actually both. And I explained it. But again, my point, Rick, is that I don't have a crystal ball, but I do have better models using complexity theory. And one of them is most of Wall Street, most people doing this kind of analysis assume what's called a normal distribution of risk, normal distribution of profit and loss. Normal distribution is a bell curve, and you have a large number of very small events and really tiny number of very extreme events. But you get to the tail and it hits the x-axis, which is zero, basically. So you say, these extremes, this will never happen. I mean, Jamie Dimon embarrassed himself a couple of years ago in their annual report. When that was the London whale thing, and he said, statistically, this should only happen once every 30 billion years. I said, it must have been a really bad day, Jamie. I mean, that's longer than the life of the universe. But he was using the bell curve. He was using normal distribution, and that's the wrong model. If you use a power curve, which is a different curve, a different degree distribution, the power curve doesn't get to the x-axis. It kind of flattens out a little bit because on indefinitely. But that gap between the x-axis and the actual curve, those are the extreme events, and the y-axis is the frequency, meaning those extreme events happen with much more frequency than the bell curve would predict. Now, people pay that lip service and they call it the fat tail. Remark is, if you have to put a fat tail on a bell curve, it's not a bell curve. It's something else, and you don't understand what it is. What it is the power curve. But I've used that in counterintelligence. I've used it in financial warfare, financial war games. I've used it in risk management. But that all came out of kind of my personal search for what went wrong at Long-Term Capital Management. That was one problem that they had, which was, the normal distribution risk. It's not normal. They had another problem, which is which you see a lot, which is a lack of cognitive diversity. And what that means is IQ points count. Yeah, that's fine. We're all for that. But you need different perspectives and different backgrounds if you're going to have a successful anything, risk management or just any business as far as I'm concerned. And these guys all came out of the same mold. They all came out of one of like four schools. It was either Harvard Business School, MIT, University of Chicago, maybe Stanford, and they taught each other. Like Bob Merton was Eric Rosenfeld's thesis advisor, and so forth. They all learned from Stan Fisher. So the point being, they all went to the same schools. They all learned the same stuff. They even taught each other, and they all thought the same thing. And I said, you could fire two partners and hire like the receptionist and the landscaper. You would lower the average IQ, but you would increase the cognitive diversity. Once a year, the landscaper would say, hey, people, it's raining. You might need an umbrella. And people don't appreciate the power of, when I say diversity, I'm talking about cognitive diversity, not DEI nonsense. But get people with different backgrounds, different skill sets. And I worked with the Santa Fe Institute and the Los Alamos National Laboratory on some of this. And, when I talk to physicists about using their science in economics and capital markets, they're all for it. Like, hey, let's do it. And like, let's get I would say, get an applied mathematician, get an economist, get a physicist, get a lawyer, get a psychologist, a behavioral psychologist, et cetera. Put that team together, get some research grants and do it. When you talk to the economists about it, they say, we have nothing to learn from you. Why would we want a bunch of physicists and all these other skill sets around? So so the problem is really on the economic side. They have the same problem my partners at Long-Term Capital had, which is they're out of the same mold. They use the same models. And, I'm picking on the bell curve, but, the Phillips curve is junk, and it's junk science. But I do a lot of Fed forecasting. So I tell viewers and readers, I say, look, what the Fed is doing, what they're using is junk science. But if you want to predict the Fed, you have to think like the Fed. So you actually have to put your Fed hat on, apply some garbage models, see what they would do, and then tell people what they're going to do, and then throw away the models. I mean, don't use them yourself, but I have to understand them. So the Fed uses QE. QE does nothing. There's been a ton of research since Bernanke started QE. There's no evidence that it stimulates anything. Low interest rates do not stimulate economic growth. Low interest rates are associated with recession and depression. If that's what you want, you're gonna. Well, if that's what you have, you're going to get your low interest rates. They don't stimulate anything. QE does not stimulate anything. The Fed is almost irrelevant. The money that matters is not created by the Fed. It's created by commercial banks. That's a whole separate topic. We can talk about the commercial banking system, but you won't see it at the Fed. The Phillips curve is junk. Inverse relationship between unemployment and inflation. Really, I remember 1980. Unemployment was 12%, and inflation was 15%. They were both high. They were both sky high. Where's the inverse relationship? So there's a lot of bad models that are used by powerful institutions. There are a lot of good models that very few people understand. I stick to the good models. But as I say, it was a long kind of journey after 1998 to grasp all that. But I had it, and I was able to apply it with partners. There were other people involved at the CIA in terms of predicting terrorist attacks. We built a prototype model that actually predicted the 2006 liquid bombing attack that was foiled by MI6 and Pakistani intelligence. But we did get a flashing red warning on American Airlines 2 days before they took down the plot. So that showed our prototype system worked. And then I enjoy writing. So, but gold is always there. I actually did a presentation the other day on what happened to Elon Musk and Donald Trump's famous visit to Fort Knox. Leave aside the fact that they're having a little catfight at the moment. I'll leave that to them. I'm not getting in the middle of that one. But a couple of months ago, when they were best bros, Elon and Trump were going to go to Fort Knox and open the doors and bring in the press and show that the gold is actually there, or maybe it isn't, and kind of do an expose. Musk was going to audit the whole thing, and that completely went away. There was never a press release from the White House. Oh, we're not doing it, or the schedules. They didn't say anything. They just stopped talking about it, and they didn't do it. Well, I know what happened. I called adult supervision, got involved. Probably Scott Besson. I'm not sure exactly who it was. It was probably Scott Besson. Said to Trump and Musk, "Don't do this." It's not because the gold isn't there. Of course, the gold is there. Those conspiracy theories have been around since the 1930s. They're all nonsense. The gold is there. I mean, only half of it's in Fort Knox. The other half's at West Point. I happen to know the location of the vault. It's classified, so I won't say where it is, but it's there. So the gold's there. That would be a complete anticlimax. But what they don't want to do is pay attention to it, because if you have the printing press, if you control the dollar, and that's the main form of money, and gold is a competing form of money, you don't want to call attention to gold. You don't want anybody to think about gold. It's like, yeah, Bernanke says it's a tradition, it's sitting in a vault. We got stuck with it, whatever. I've talked to the top people, National Intelligence Officer of Economics. This was years ago. And I said, I won't mention his name, but I said, the Russians are buying gold hand over fist. The Chinese are buying gold hand over fist. Should we pay attention to this? He kind of shrugged. He goes, somebody's got to own it. I mean, you would think it was like a yard sale or something, but I was like, no, this is a big deal. And of course, here we are today with the BRICS, and we see what's going on. And Russia has 3,000 tons, and China has 3,000 tons. They admit to probably a lot more. Good reason to believe it's a lot more. Who's buying gold? Russia, China, India, Iran, even though they're not transparent. Turkey, Japan actually added 300 tons after decades of no additions. Central banks are large net buyers. So there's a geostrategic, geoeconomic aspect to gold over and above the normal commodity trade. And that's something I was always very cognizant of, in working with the intelligence community and in the private sector.
One of the things that struck me the first time I visited with you was your description of what you think. Well, let me back up a little bit. We talked about the curves. We didn't say regression to mean, but long-term capital management was a lot about regression to mean. And as you point out, they were right until they weren't. Isn't a lot of that simply related to leverage, to anti-fragility? I look at mistakes I've made in my life. Nothing of that order of magnitude, but what's allowed me to survive a couple of them has been liquidity and solvency. And I want you to talk about the lessons of long-term management, how you can be wrong even when you're right, if you're over-leveraged and anti-fragile, and talk about how, in your mind, that relates to the average household. Do you think the average household is over-leveraged? Do you think the economy is over-leveraged? How should one conduct one's own affairs given the lessons of long-term capital management?
Well, over leverage is look, it's a big deal. If you're leveraged, you're going to lose. You're going to make money faster, and you're going to lose money faster. That's what leverage is. And I always recommend a big slug of cash in any portfolio, sometimes as much as 30%. And there's no better example of that today than Warren Buffett. Warren Buffett has $1/3 trillion in cash, about $330 billion in cash, the most he's ever had. Why so much cash? The greatest stock picker of all time. He isn't really, but what Buffett is the master of. He's a pretty good stock picker, but not the best. But he's the master of tax deferred compounding. Just just but tax deferred compounding relies a lot on not losing money. So of course you want to make money, that's key. But don't pay taxes if you can possibly avoid it. That's why he bought an insurance company, because Gen Re, when Buffett, that was around I'll say around the early '90s, give or take. But Buffett's portfolio was very heavily weighted to stocks, and he wanted to diversify into bonds. And he said, well, what would most people do? I'd sell the stocks and buy some bonds. But if you sell the stocks, you got to pay taxes. So what he did was he used his own stock, Berkshire Hathaway stock, to buy Gen Re, which had a enormous bond portfolio. So he basically doubled his balance sheet, but he equilibrated between stocks and bonds without selling any stocks or paying taxes by acquiring an insurance company, which is basically a bond portfolio and a stock for stock deal, which was also tax free. So he gets very good tax advice. So tax deferred compounding is the real secret of Warren Buffett, but that relies a lot on not losing money, because it's a long road back. But why does Buffett have $1/3 trillion in cash right now? He sees what I see. He sees what's coming, and the great thing about cash is the exact opposite of leverage. Leverage increases your volatility. Cash reduces your volatility. And I recommend, even in a portfolio where out on the wings, you've got volatile assets. Gold can be volatile. I like it, but it can be volatile. Stocks, certainly volatile. Bonds can be, etc. But if you have a slug of cash in the middle, you can still own those volatile assets and make money, but it reduces the overall volatility of the portfolio, so you can sleep better at night, number one. Number two, people don't understand. Yeah, it's not a big return on cash. Well, it's better than it used to be. You can get, depending on your instrument, you can get 3-4% these days on cash or cash equivalents. What has huge embedded optionality, what I mean by that is, when everything collapses, you can go shopping. Everyone else is like selling the portfolio, fire sale, in distress, margin calls, got to get money, got to deleverage, can't do it fast enough, and you're losing money all the way down. But the guy with cash can just watch it happen, take a beat. You don't have to pick the exact bottom, wait till it hits bottom, and then go out and get some very good companies or commodities or anything else at bargain basement prices, but you need the cash to do it. So cash reduces volatility, helps you survive, lets you go shopping when everyone else is puking their portfolios. And those benefits are greatly underestimated because they're not really visible. There's no price tag on it. But if you understand options theory, I shared an office with Myron Scholes for 6 years, so I see options under my desk. But if you understand optionality, it's very valuable.
Before we went on the air, we talked about a few things that you're doing now. And one of them I think is quite interesting. Uh, it, it, Interesting in the sense of the Soros quote that you make money by finding a broadly held public perception that's wrong and betting against it. Talk to me about what you call MAGAnomics, and what individual investors in Wall Street are getting wrong about MAGAnomics. By the way, ladies and gentlemen, be prepared to be scandalized. We like this for the interview.
Well, I'm pretty critical of economists. I come down hard on them, and I think with some justification. But there are some good ones out there, and one of the ones I like is Robert Schiller at Yale University, and he wrote a book 4 years ago, but it's 4 or 5 years ago, easily available. You can find it on Amazon. It's called Narrative Economics, and I had worked in that field, have for a long time. But he put it together in a really good book, and he said. A lot of what happens in markets, you got fundamental analysts, they're looking at, earnings and surprises and risks and present value analysis and alternative investments, et cetera. Then you've got technical analysis, which is, I'm familiar with it. I'm not expert in it. I think I use it to tell me where I've been. I think the predictive value of it is low, but it has its fans, and I'll give them that. But he makes the point that markets really are not driven by fundamental analysis or technical analysis. They're driven by narratives. Narrative is just a story. And Wall Street is great at putting out stories, and they don't have to be true. That's the important point. Some of them are, not all of them, but he gives the example of the Great Depression. He said during the Hoover administration, in the late 1929 to 1933, which was the worst part of the Great Depression. It continued after that, but that was the worst part of it. Yeah, unemployment was 25% and people were broke and businesses were failing. It was pretty bad, but not everybody was broken. Not everybody was unemployed. And there were a lot of rich people around. Just look at, Hollywood and Joseph P. Kennedy and a lot of others. But it became very gauche, I would say, to show off your wealth. Like, don't have a fancy car, don't wear a fur coat. It was just, people were suffering. Don't put on your best jewelry or your fur coat, whatever it was. That was a narrative, but it hurt consumption. It actually made the depression worse. It wouldn't have been a bad thing if people had spent money. That might have been what it would have taken to get the economy moving again. That all changed in 1933 with FDR. And remember, the theme song of the 32 election, 33 sworn in FDR campaign was Happy Days Are Here Again. That was the Democrats' theme song. All of a sudden, the narrative shifted. And it's like, yeah, let's go buy that car, buy that house, wear a fur coat. And the stock market did extremely well in 33, 34, and 35. And it was in the middle of the Great Depression. You had a rally. Now, it crashed again in 37 and 38 because of the Fed. So what you really had were two severe recessions inside of something called the Great Depression. And if you say the Great Depression lasted from 1929 to 1940, I think that's right. But there were two separate recessions, 29 to 33 and 37, 38. But a little boom period in between it in 33 and 36. It was because the narrative changed. I mean, the economic policy didn't change all that much. So what are some of the narratives we've kind of lived through recently? Well, remember the soft landing? Remember the Goldilocks economy? This idea. My favorite was the pivot. So the Fed started raising interest rates in March 2022. They stopped raising interest rates in, I believe it was June or July 2023. They took them up, 5.5%. It wasn't the highest rate ever, but it was the fastest increase of that magnitude ever. But as early as the late summer of 2022, not long after the Fed started raising rates, Wall Street came up with this narrative they called the pivot. The Fed was going to pivot to rate cuts. And so it gave stocks a boost. So I knew they weren't. They were still raising them. And I watched it all through late 2022, all through 2023, all through 2024. It wasn't until September 2024 that the Fed actually cut rates. But for those 2 years, everyone on Wall Street is like pivot, 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 get ready for the rate cut. But every time they said it, stocks went up. And I was watching this, I was thinking, well, okay, if you said it once, then maybe stocks should go up once. But how come if you say it 5 times, they go up 5 times and you're wrong every time? But that was a good example of a narrative that had power, that affected behavior, that was not rooted in reality at all. The Fed wasn't anywhere close to cutting rates, but Wall Street talked it up. And so when I see those narratives, I probe them, and it's pretty easy to see which ones are false. Now, you don't run right out and short it right away, because as you said, Rick, and you're right, you can lose a lot of money being right. I knew the Fed wasn't going to cut rates, but I didn't want to, at least at the time, but I didn't want to bet on a rate cut because, bet against it because the market was taking the opposite view. So that's where you bring in behavioral psychology, and that's really what Schiller was talking about. So the short answer is, watch out for narratives. Some of them are true, but a lot of them are false. But they all have power, and don't fight. Understand that the narrative is false to get ready for your next move, but don't do it right away. Don't fight the narrative because you can lose money in the meantime. And as far as long-term capital management was concerned, yeah, over leverage was an issue. Lack of cognitive diversity was an issue. This is where, the best traders of all time, and I work for some of them, Bruce Kovner, Caxton, and others. They're very good at stopping out. Like, put a trade on and lose a little bit, just a little bit. They'll get out of the trade like that. That's nature's way of telling you you made a mistake. Now, most traders, and this is where they all go wrong, is like they lose money. Like, well, uh, it, it just got better. The trade just got better. I'll do more because, it went against me. So I'll do more at a better price. And then it moves against them again. It's like, well, I'm right. The market's wrong. I'm just going to double down. And they double down until they've lost all their money and then they get fired. And the best traders will have tight stops. They'll get out as soon as they lose a little bit. They'll get out, to get a good night's sleep, come back, maybe put it on the next day, maybe not, but live to fight another day. Uh, it runs against human nature, but you kind of need ice water in your veins to do this well. And it's very good advice. And I got to say, the best traders I ever knew, and I would put Bruce Kovner in that category, were very good at that, at having tight stops.
Tell us, however, what you think the market's getting wrong with MAGA economics or MAGAnomics.
Sure, and this will be. I'm glad to say this will be my presentation at the Rule Symposium. Uh, it'll be the first time I've done. I've been working on it for a while, and I've written some articles about aspects of it. But this will be the first time I'm kind of world premiere, if you want to think of it that way. But so actually, this is a good example, Rick, of a narrative. So what's the narrative on Trump? MAGAnomics is short for the Trump administration, second term economic policy. So what's the narrative? The narrative is, Trump can't make up his mind. He puts, high tariffs on, then he pulls it back, and he lowers tariffs and he changes his mind, on again, off again, 60-day pause. What the heck's going on? And then the same thing in tax policy, the big beautiful bill. They're going to increase the SALT deduction. Then the Senate says no, and people step back and go, "This thing is at best uncertain and unpredictable, and at worst, it's just chaos." And somebody came up with this acronym TACO. I guess Trump always chickens out, I guess is what TACO stands for. That's the narrative. And markets are responding to that. They're putting a premium on 10-year yield to maturity on 10-year Treasury notes because of the uncertainty factor. Gold goes up or down depending on whether you think stocks are going to rally, et cetera. So it is having real impacts on real markets. But here's my point. The narrative is wrong. Economics is actually very well thought out, very coordinated. I know all the people by reputation, and a number of the people personally, I've spoken to them who are behind it. Really smart people, but not just smart. They've been working on this for 4 years. The funny thing about the way the election was stolen in 2020, was that the Trump team knew that they kind of won in 2020, but the election was stolen. So they said, well, we're going to win the next time. We're going to win in 2024. All we have to do is stop the cheating. Harmy Dillon and others went out. They got 500 lawyers and tens of millions of dollars, and they changed some laws and they put a lid on the cheating. At which point, it was fairly easy to predict that Trump was going to win, which I did. By the way, since we're talking about predictive analytics, my election forecast, it was the best one in the world. I mean, take your pick. Big, Rasmussen. Nate Silver, all these guys. I said 312 electoral votes. I said he would win 7 out of 7 swing states. I did it in writing in advance. But again, I don't have a crystal ball. I use the kind of models that I'm talking about to predict that. And I talked to one forecaster. He thought Trump would win, but he said, "You got Michigan?" I said, "Yeah." I said, I was either going to be right about all 7 or I was going to be wrong about all 7 because I used the same method, but it turned out to be right. But I understood how the polls were skewed and how to reverse engineer that. But my point is, they knew they were going to win. The Trump team did, and they've been working on this for 4 years. This was not cobbled together during a 60-day transition. So they're rolling it out. Some of it's hard to understand. I'm going to explain it it's technical, it's high level, but I can do it in plain English, and I'm going to do that at the conference. But on tariffs and trade. Trump's going against globalization. Doesn't he know that tariffs are obsolete and blah, blah, blah? No, the United States was built on tariffs. Going back to George Washington, Alexander Hamilton, Henry Clay, John Quincy Adams, Abraham Lincoln, William McKinley, Calvin Coolidge, Dwight Eisenhower, they were all pro-tariff. And that's how America got to be a great country. So all we're doing with tariffs, we're going back to what was actually called the American system, and that was the name for it. Henry Clay Alexander Hamilton invented it. George Washington endorsed it. Henry Clay gave it the name, the American system, but it was always based on tariffs. And the other, so we're going to talk about that. We're going to talk about the three arrows. That's Scott Besant's plan. A little technical, but how to solve the U.S. debt problem. Look, you're not going to get rid of deficits. You're not going to get rid of the debt. All these people got to pay off the national debt. No, you don't. You don't have to pay off the national debt. You just have to roll it over, which we've been doing since Alexander Hamilton, since 1790. So what gives you the ability to roll it over? Sustainability. It's not based on the size of the debt or the size of the deficit. It's based on the ratio of debt to GDP. So you've got to factor in growth, and that's the thing that everyone's ignoring. So we'll talk about that. We'll talk about the Mar-a-Lago Accord. By the way, this is Stephen Moran, M-I-R-A-N. Wrote a very densely worded, very good 20-page, single-space, 5-point font article in last November. But he used the phrase Mar-a-Lago Accord. If you're one of my readers, you know that I invented that phrase in my 2019 book, Aftermath. I have a chapter called the Mar-a-Lago Accord. So you had that 6 years early, if you read that book. But it's back in the news, and Stephen Moran uses that phrase. Well, what is the Mar-a-Lago Accord? How does it work? How do tariffs work in a world of floating exchange rates? If I slap a 20% tariff on you, and you devalue your currency by 20%, you're no worse off. You just change the terms of trade. So we'll explain that, and then also again the role of FX as a reciprocal function of tariffs. So we're going to go through all of it step by step. But I think when we're done, the attendees will see that it is coherent. It does make sense. It's well thought out, and it's going to be very successful.
James, thank you for all the work you've done on behalf of both investors and taxpayers. Thank you, too, for your ongoing support of the Natural Resources Investment Symposium. To the extent that the people watching this interview want to learn more about your work, buy your books, subscribe to your newsletters, how do they find you? How is James Rickards accessible to normal, living, breathing human beings?
Well, it's not that hard. All of my books are available on Amazon. My first book, Currency Wars, is well known, but my most recent book just came out last November. It's called Money GPT. Money GPT, and as the name implies, this is about the mashup of artificial intelligence and capital markets and banking. And there was also a chapter on nuclear warfighting. I'm not bashing artificial intelligence. It's here to stay. It's in your refrigerator. It's on your dashboard. It's probably in this recording, this interview, and it's very powerful. So it's not going away. And you can make good use of it. But I make the point that there are hidden dangers in AI for capital markets that are being overlooked. And I point them out and explain them and give recommendations on how to avoid that. Same thing with the banking systems. And I also explain why there will not be a singularity. There are limits on AI, and I explain what they are. So Money GPT is my book. On X, you can find me at Real Jim Rickards. At Real Jim Rickards, that's me. When I do interviews, I put out the link, so it's a good way to follow. And then my newsletter is Strategic Intelligence. Just Google, Jim Rickards Strategic Intelligence from Paradigm Press. You'll find our landing page, and I hope people enjoy it and subscribe to it.
Look forward to hosting you at our symposium. One of the things I love about James Rickards is he doesn't come down and give a speech and then go hide in the room. You interact with everybody, so people can look forward to seeing and hearing you in the flesh. Thank you again, sir, for subjecting yourself to this interview and also for your support of the conference.
Thanks.